Hello everyone and welcome to today's video. And Nike just reported earnings not too long ago, and as a shareholder of the company, I wanted to go ahead and give some of my thoughts, go through some of the financial statements and a little valuation projection that I ran given what I expect the stock price to do and whether I think it's a good opportunity here or not, as the stock has been beaten down pretty considerably. So first, we can go ahead and start off and just look at how the stock price performance has done. And if you haven't been keeping up, the stock price has been pretty brutal. And you can see year to date, it's down about 30%. And I think even on the 1 year, it's down even more than that. 42%. Yeah, so it's just been on a constant downtrend for quite a bit. And a lot of that did have to do with prior management really messing up some strategical plays. A lot of direct to consumer is what they were doing, and they lost a lot of shelf space, which in turn gave room for a lot of other competitors in that athletic footwear space to start taking market share, like Hoka or On, some of those other competitors you've heard of. But with this new strategic shift in place, with Elliott Hill being put in place, we're starting to see, is there actually a shift? Is what he's doing working? Is this a good turnaround play, or is this going to be something that's more of a value trap and a long-term opportunity cost more than anything? So first thing I want to run through is just their income statement they reported. I'm focusing on the actual full year numbers. So first, if we go ahead and look at their income statement, I went ahead and gave it a grade of a C plus. Key things, so revenue was flat, which we don't like to see. We want to see that being upticked. On the bright side, though, the actual cost of sales did not move as well, which I guess is pretty good for positive. And in addition, net income was down, which we do not like to see. Now, I have this little reconciliation here. As you can see, it looks like in the quarter that 72 cents of earnings per share was really good, but in fact a lot of that was due to this tariff benefit refund they received. So backing that out, they were still up decent for the quarter, but still on a full year basis, regardless, they were still down. So for that reason, I graded them a C plus. If I can point to any bright spots on here, well, it's not even really a bright spot. It's at least selling and administrative expense wasn't up as a percent, but if anything, I'd like that to be down, especially if revenues aren't accelerating. Now, if we come down here to the divisional revenues, which is kind of the area I want to focus on more. First off, I broke up all the different major divisions by the percent of revenue they contribute, with North America being the largest at 45%, Europe's at about 28%, China 13%, and Asia and Latin America at 14% of revenues. So each division is pretty considerable in terms of contributing to the actual bottom line. However, of course, North America and Europe are the ones that are going to be contributing the most, but the other divisions are still significant enough. They're above 10%. So North America, on the bright side, that spot is doing pretty good. Revenue growth of about 5%. Now, here's where the trouble starts coming in with Europe. So the growth overall for the year was 3%, but we can see that the actual equipment was first off flat, which isn't the greatest to see, and footwear was barely up 1%. In addition, if you're excluding the actual currency changes, so they got some benefits from just currency fluctuation rates, they were actually down by 3%, which we do not like to see there. So they were actually being benefited by those currency exchange rates, so it made it look better than it is. So even though it says it's up 3%, realistically, in terms of what they were actually doing in their business, they're actually down, which is concerning to see, especially considering, again, it's almost 30% of the revenues. China did pretty horrible overall. They've had a lot of trouble in China as of lately. At least on the conference call, Elliott Hill seemed like he had a plan for that, and there were already talks being on. So if we're in a hopeful spot, maybe this can start turning around, but you can kind of see it's kind of a train wreck. Footwear down 13%, 15% on a currency neutral basis. Apparel down 7% on a currency neutral, and equipment down a whopping 25 and 26%. Of course, this is a smaller base, but still it's 13% of total revenue. So when 13% of your revenues are down double-digit percents, that's never a good thing. And it's kind of the same thing over here in the Asia, Pacific, and Latin America. Apparel was a strong spot where they were up about 5%, 1.5 million to 1.6. But again, footwear down and equipment down. So overall, they were relatively flat, down slightly. So with that, of course, my main thing whenever I'm looking at this, I'd like to see more signs that these areas internationally start showing more strength and turnaround. And that's one of the things I'm really looking for as an investor in terms of if I'm going to put more capital into this position. Currently, I do have a position in it, but in terms of allocating more, even at these prices, I need to see that these other international plays are starting to have some more acceleration, because if they don't, that could be a pretty big problem. So having said that, there are some things I do want to highlight with it. First off, something interesting to note, if we go ahead and go over to this insider tab, one thing I do like to see is that the CEO is buying a decent amount of shares. We can see first block in about December, he bought about 1 million. And then again in April, a block of 1 million, about another 1 million 3 days later, and then another 1 million. So all in, that's like 1, 2, 3, about $4 million worth of buying the stock, which is great to me. There's only one reason that the chief executive of the company, those C-suite executives, are gonna buy stock, and it's because they believe it's going to appreciate. So that makes me more hopeful that he does also believe in the turnaround. He's not just speaking to speak and try to pump the stock, which is great to see. Now, the other thing is getting closer into the actual valuation of the company. So if we go ahead and turn over to this freeform tool, I was trying to see what the best way to value this stock would be. So I had a few metrics pulled up, and first off, we can start with price to earnings, which right here we can see it's fluctuates a bit, but not nothing too crazy. Low end of 17, high end of 48. But surprisingly enough, if you look at the free cash flow and operating cash flow, that one fluctuates a lot. Like you can see, it reached some highs like in the hundreds right there. So very high delta between its high and low. 14 low, 112. So I didn't want to use operating cash flow. Operating income was actually one of the more stable metrics, which is what I decided to use to run my actual valuation with. If we look at operating income, which right there, it's about in line with the price to earnings ratio, but it still seems a little more conservative than that. So I will be using that in terms of our projections. We can see that currently they're trading at a 23 price to operating income. Their median has been around 26 and average also around 26, close to that 27 range. So with that being said, when I'm looking at operating income, we can see it's been consistently going down as of lately, and that's just kind of with the company being in this decline over the past 5 years. As you can see, even with the revenue, also the revenue has not been great, like barely moving, and then the operating income has just been going down and down, negative 2.8% CAGR on that. And we can see that in the actual margin, the operating margin, as we can see, it's down to a 6.03, which I believe is the low. If we look right here, if we look at the margin, yeah, it's actually at the lower point, a 6.03%, with an average and median around the 11.5%. Now, I do believe from what the focus has been with Elliott Hill, a lot of these margins should be improving. They're trying to not do as many discounts. So I do believe this is going to be accretive for margin. So I expect this to go back, which is something I factored into my valuation, but I'm just putting that there. It's at the lowest right now. I personally don't expect it to go much lower. If anything, I expect a higher chance of it appreciating over time. Now, if we turn back over here and look at what analysts are expecting. Currently, on average, they're expecting about revenue growth of about 4.84%. If we look at EPS growth, they're looking at about 23%. So again, that kind of ties in with them expecting higher margins as well as buybacks, which the company typically does pretty frequently. I think right now for buybacks, they're averaging about 2%, if I remember. 2%. Yeah, just about negative 2% CAGR for the shares outstanding. So with that actually being said, I'm going to go ahead and pull this back up, and we can go ahead and look at this projection I ran on this Excel. And apologies, I know it's not too neatly organized, but just to kind of explain, run through this. Right now, for the original projection I ran, I have a growth rate going of 5% of revenue. So I have this going out to 2031, which implies that by 2031, they'll be doing just about $59.2 billion of revenue. I have the operating margin expanding to 10%, which, remember, that is below what they've been doing on average. Sorry, I got so many tabs open. Okay, that's below what they've been doing on average. As we can see, their actual median and average operating margin has been around the 11.5 to 11.76, whereas I am putting 10 at the end, so I don't even have that getting back to what their average is. Trying to be a little more conservative there, but still give room for expansion. Now for the shares outstanding, I discounted it by about 1.8% a year to factor in the buybacks. They seem like they're going to consistently keep doing the buybacks as well. This valuation model did not factor in the dividends, just heads up, so just think of that as well. And that gets us our implied operating income per share by 2031 of $4.38. Now, for the price to operating income, on the higher end, I used 28. Remember, their 26 is around where their median's been. On the higher end, it's been closer to the 30s. I didn't want to go that extreme with it, so to be a little more conservative, 28 for the high end. The medium range is 25, which is still under what their median was, and the low range I had as 20, which isn't as low as it's gone, but it's still a decent amount lower than that. Now, this gives implied share prices on the higher end of 122, medium end 109, and then the lower end 87. Discounting that back, I always use a 15% discount rate because that's what I typically look for whenever I'm investing as a minimum. And we can see an implied fair value at today's price of 43 to 60 is the range we have right here. Currently, the stock price is sitting at $44.09. So if you were to buy today and these assumptions were to occur, even on the lower end, you'd still be getting about a 14.7% CAGR. And again, this is highly affected by that operating margin, and if they're able to keep their expenses in line and start growing that operating margin back up. For example, if I have them going back to, let's say, 11.25, so still under the median, but about 125 basis points above what I just had them at, you can see how much that pushes up. Now, even on the lower end, your CAGR raised up to 17, 22, 25, and you can see how much those fair values raised. Now you're actually in the green zone for the low end. So just something to think about there. Now, again, what are my plans for the stock? Me personally, again, I am fine just holding this position, collecting the dividends I have on it. I don't find any real need to go in and buy more of the stock at these prices. If it went down considerably more, I would be considering it. However, there are just a lot of good opportunities in this market currently that make it to where I don't feel the need to just go out and buy this, especially when I can just wait a few quarters, let a few quarters pass and see, okay, is Europe, is China, does it look like it's starting to flip and they're going back to growth? Maybe at least neutral instead of China going down like 10%. Is their revenue starting to stabilize and now they're maybe at 1% or even like just completely flat? Then I'd be more comfortable. But I need to see some signs of that, some signs of the actual initiatives working before I put more capital into this position. And again, like I said, there are many other great opportunities in this market. Meta's an amazing opportunity right now. but that one's already my largest position. But Meta, I'm gonna make a separate video on that later. But obviously, they just had that announcement, if y'all haven't heard, where they're gonna start doing some data centers as well and selling out their compute, kind of like AWS and Azure. So that is going to be another revenue driver for them. Again, Zeta, I've been preaching about that one, just talking about it as much as I can, because I do think that one's just a huge opportunity, especially with their partnership with Palantir, where they're layering on the Zeta Foundation with Foundry. It's going to be insane. And even Palantir itself, which I haven't added any, but I have been considering it at these prices, because with their growth rates, they're actually not too expensive, honestly, with their growth rates. The only problem I have with that is I kind of rather just put my money in Zeta right now, because they're a smaller market cap and it has more room for upside due to that. And also, I'm just trying to like keep my money spread between different positions as well. But with that being said, I hope you enjoyed the video. If you have any suggestions on any other stocks I should cover, any other earnings, please let me know down below. And also feel free to check out that video I had on Zeta and Palantir. It was a video right before this one, and it's a pretty good listen. I go through a bit of the actual press release they had, and then I went through a bit of the CEO highlights in an interview they did on a fireside chat, which with David Steinberg, the CEO of Zeta. So if you're interested in that, it'll probably be up here on the screen somewhere. But thank you. Take care.